It began with a house. Not a grand mansion on a hill, not a gleaming penthouse overlooking the city skyline, but an ordinary two-story suburban home with a small lawn and a white mailbox. In the summer of 2006, it was worth nearly $400,000. At least, that's what the papers said. The family inside had been told the same story millions of Americans were hearing. Home values only go up. If you could get approved for a mortgage, you weren't just buying a place to live. You were stepping onto an escalator of wealth that would never stop rising. Banks were eager to help. Approval was quick, the questions few. It didn't matter if your income was shaky or if you'd never owned property before. Somewhere in the background, far from the kitchen tables where pens signed the contracts, those mortgages were being bundled, sliced, and sold to investors around the world. On Wall Street, the numbers looked perfect. The machine was running at full speed, feeding on home loans from every corner of the country. Traders called them mortgage-backed securities, and they seemed as safe as gold. After all, everyone needs a home, and everyone knows home prices don't fall. It was a beautiful illusion, one built on millions of tiny, fragile promises. And in just a few short years, that illusion would shatter, sending shockwaves through every bank, every market, and every home on the planet. By 2004, the housing market had transformed from a steady climb into a rocket ship. In mortgage offices from Miami to Las Vegas, the atmosphere felt less like a bank and more like a carnival. Loan officers in shiny suits handed out approvals like raffle tickets. If you had a pulse, you could get a loan. If you didn't have a job, they could find creative paperwork to make it look like you did. They called them ninja loans. No income, no job, no assets. And yet, the approval stamp came down with a satisfying thud. Why not? The banks didn't plan to hold the loans for long. Behind closed doors, those mortgages were packaged together into massive bundles. Thousands of home loans mixed like ingredients in a cake. These bundles were sold to investors as if they were safe, predictable sources of income. Credit rating agencies stamped them with the highest possible grades, ignoring the fact that many borrowers were already struggling to make payments. On Wall Street trading floors, the appetite for these bundles was insatiable. Pension funds, foreign banks, and insurance companies bought them by the billions. Each sale freed up more money for lenders to hand out more mortgages. It was a feedback loop, one that grew faster and hotter with every passing month. House prices soared. In places like Phoenix and San Diego, homes doubled in value in just a few years. Ordinary families watched their neighbors sell at record highs and felt the pull. Buy now, or be priced out forever. No one wanted to believe the ride could end. But deep in the numbers, in the payment schedules and missed checks, the cracks were already forming. By late 2006, the first signs of trouble began to ripple through the perfect facade. In small towns and sprawling suburbs, for sale signs started to linger longer on front lawns. The bidding wars that once drove prices sky-high slowed to a crawl. In some neighborhoods, houses that had sold in weeks now sat empty for months. In bank call centers, collections departments noticed a troubling trend. More and more homeowners were falling behind on their payments. Many of them had taken out adjustable-rate mortgages, lured by low initial rates that suddenly reset to much higher monthly bills. What had once been manageable now became impossible. On Wall Street, a handful of traders began to whisper that something was wrong. They dug into the data and found that default rates, the percentage of borrowers missing payments, were rising far faster than anyone had predicted. But the machine was still running. Most executives dismissed the warnings. Housing was a local issue, they said. A few bad loans in Florida or California couldn't possibly bring down the entire system. Meanwhile, in quiet conference rooms, a small group of investors were making a different kind of bet. Not on the housing market's endless rise, but on its collapse. They were buying insurance contracts called credit default swaps, which would pay out massively if mortgage-backed securities failed. It was a gamble that seemed insane, until the numbers started to make sense. By the spring of 2007, the whisper had turned into a steady drumbeat. Major lenders that had once been the lifeblood of the housing boom were beginning to fail. New Century Financial, one of the largest subprime mortgage companies in America, filed for bankruptcy. It was a name most homeowners had never heard, but on Wall Street, it sent shivers down the spine. If one major lender could collapse, how many others were standing on the same shaky ground? Foreclosures surged. In cities like Cleveland and Stockton, entire streets stood half-empty, lawns overgrown, mail piling up on porches. The American dream of homeownership had turned into a nightmare for hundreds of thousands of families. Yet, the stock market kept climbing. The headlines still spoke of strong corporate earnings. Most people outside the financial world didn't see the storm gathering. Not yet. Inside the trading floors, however, the mood was changing. The once unstoppable market for mortgage-backed securities began to dry up. Investors who had been eager to buy now hesitated. Prices for these once safe assets began to fall, slowly at first, then faster. And then came the shockwave. Bear Stearns announced that two of its hedge funds, heavily invested in mortgage-backed securities, had lost nearly all their value. Billions of dollars had vanished. It was the first real crack in the dam, and the water was rising. By September of 2008, the storm that had been building for over 2 years finally broke. On the morning of September 15th, the world awoke to the news that Lehman Brothers, a 158-year-old investment bank, had filed for bankruptcy. It was the largest bankruptcy in American history. Employees streamed out of the glass tower in Midtown Manhattan carrying cardboard boxes, their careers and savings wiped out overnight. The markets reacted instantly. The Dow Jones Industrial Average plunged hundreds of points within hours. Across the globe, from London to Tokyo, stock exchanges went into freefall. A day later, another shock. Insurance giant AIG teetered on the brink of collapse. It wasn't just an insurance company. It was the silent backer of countless mortgage deals. If AIG failed, the losses would ripple through every major bank in the world. Credit markets froze. Banks stopped lending to each other, terrified that the next phone call might bring news of another collapse. Ordinary businesses couldn't get loans to make payroll. Consumers couldn't finance cars or homes. The economy was seizing up like an engine without oil. On Main Street, panic began to replace confusion. Retirement accounts shrank by half. Home values fell further. Job losses surged. For millions of Americans, it felt as if the financial floor had disappeared beneath their feet. The crisis was no longer a headline on the business page. It was at the dinner table, in every household in the country. In Washington, the mood was grim. The Treasury Department and the Federal Reserve faced an unthinkable choice. Let the market burn itself out, or intervene on a scale never before attempted in peacetime. Treasury Secretary Henry Paulson, a former Wall Street executive, stood before Congress with a blunt message. The financial system was days away from collapse. Without immediate action, the crisis could spiral into another Great Depression. The plan was called the Troubled Asset Relief Program, or TARP. It authorized $700 billion to buy toxic assets from banks and inject capital directly into the financial system. The goal was simple: restore trust, get credit flowing, and stop the bleeding. The move was controversial. Many Americans saw it as a bailout for the very institutions that had caused the disaster. Protesters gathered outside the Capitol, holding signs that read, "Bail out Main Street, not Wall Street." But behind closed doors, lawmakers knew the stakes. If the banking system collapsed entirely, businesses would fail by the thousands, unemployment would skyrocket, and the damage would spread far beyond the borders of the United States. The first funds were injected into major banks within weeks. The Federal Reserve slashed interest rates to near zero and launched emergency lending programs. Gradually, painfully, the markets began to stabilize. The rescue had stopped the freefall, but the wreckage was everywhere. The financial system had been pulled back from the edge, but the damage to ordinary Americans was deep and lasting. By 2009, unemployment in the United States had soared to over 10%. Millions of homes had been foreclosed. Entire neighborhoods in cities like Las Vegas and Detroit stood half empty, windows boarded, weeds overtaking once proud lawns. Families that had worked for decades to build security now found themselves starting over from nothing. Trust in Wall Street and Washington was shattered. The idea that markets could regulate themselves had been exposed as a dangerous myth. Politicians promised reforms, new regulations, and stricter oversight to prevent another catastrophe. Some of those changes stuck. Banks were required to hold more capital, mortgage lending standards tightened, and exotic financial products came under heavier scrutiny. But the deeper lesson, that unchecked greed and blind faith in rising markets can destroy an economy, remains as relevant today as it was then. The 2008 mortgage crisis was not just a story of bad loans and failed banks. It was a story of people. The banker chasing a bonus, the family signing a mortgage they didn't fully understand, the trader betting the house would always win. until it didn't. And perhaps the most sobering truth is this: financial crises are not relics of the past. The same forces, ambition, fear, and the belief that this time is different, are always gathering somewhere, waiting for their moment. History has shown again and again that the next storm always comes. The only question is whether we will be ready when it does.